The FHA just released some new guidelines on how they're going to be calculating student loans moving forward. Now, if you've tried to qualify for an FHA loan at all and you have student loans, you probably understand how difficult this was under the old rules. This is because the FHA had some pretty complicated rules depending on the status of your student loan. Now, previously, if you were deferred on your student loans, the FHA would take 2% of your outstanding balances and add that to your monthly debt to income ratio. Now, for somebody with a lot of student loans, that could be a lot of money. And even if you were in repayment, most people are in some sort of income-based repayment plan. So unless your student loans were in a fully amortized payment, that means you were probably paying a lot less per month. Now, previously, the FHA wouldn't take into account what you're actually paying. What they would do is they would take the greater of whatever was showing up on your credit report or 1% of your outstanding balances. So once again, with somebody for a lot of student debt, this could be a huge hit on their buying power. But today, as the U.S. Department of Education is obviously making some changes to variable income and variable payment schedules for their student loans, HUD is making some changes too to make sure that their FHA loan guidelines reflect that in their ability to qualify borrowers, especially in the DTI calculation. So now moving forward, regardless if you're in deferment or a fully amortized payment plan or an income-based payment plan, the FHA has released some new guidelines that's going to make it a lot easier for you to qualify for a home loan. Starting in August, your lender is going to be able to use one of two calculations. Either the payment that's showing up on your credit report as long as it's greater than 0, or a 0.5% as opposed to a full percent or 2% previously of the student loan balances outstanding. Additionally, if your student loan has been canceled, forgiven, discharged, or otherwise paid in full, your lender can actually completely omit this from your debt to income ratio. So as you can imagine, that's a huge difference when it comes to qualifying for somebody for a home loan. For example, under the old calculation, let's say somebody had $100,000 in student loan debt and it was in deferment. Well, your lender would have to take 2% of that, which means that's a $2,000 a month hit on your debt to income ratio when you're not actually paying that right now. Now, under the new rule, your lender would be able to use only $500 a month as opposed to $2,000. So that's $1,500 a month less towards your debt to income ratio. Additionally, if your student loan was in repayment, they would actually be able to use whatever your repayment is as long as it's greater than 0. So under the old rule, $100,000 student debt means you're using the 1% rule, so that's $1,000 a month. Versus now, they would be able to use whatever your payment actually is. For most people, if it's in a lower payment plan, that could be as little as $50 a month that they're using to get you qualified. And so not only is this a big win when it comes to your overall debt to income ratio, but as you know, debt to income ratio is directly tied to your purchasing power as a buyer as well. Now, as we've talked about on this channel and other videos, every $55 to $60 a month shakes out to about $10,000 in purchasing power. So in this example, if you're able to save off of $1,000 a month towards your debt to income ratio, towards your liabilities, that's about $166,000 in purchasing power that's back to you as a buyer. And for a lot of people, that's the difference between continuing to rent and buying their first home. So overall, I think this is a really good and welcome change. For a long time, the FHA's calculation never made sense, honestly. It wasn't a very common sense thing. It didn't apply to a lot of people. So now I think this change is going to help a lot more people become homeowners, especially this year. But as always, I'd love to know your thoughts and questions. What do you think about this rule change? Do you think this is a good thing for home buyers? Does it make sense to you? And if you have any more questions about how this applies to your particular situation, make sure you leave them down in the comment section down below. But anyways, that's it. I just wanted to keep this one short and sweet and bring you this information as I get it. Obviously, we'll know more as lenders start ruling out how they're going to be treating these as we get closer to August. But overall, I think this is a huge win for homeowners and potential home buyers as well. And of course, guys, if you learned something new, if I brought you some value today, it would mean the world to me if you hit that like button, helps out with the algorithm, and hit subscribe if you want to see more content just like this. Otherwise, appreciate you for stopping by. Make sure you tune in for the next one. See ya.